You've heard it 1,000 times. Renting is throwing your money away. You're paying someone else's mortgage. Your uncle probably said it at Thanksgiving right before he asked when you're finally going to stop wasting rent and buy something real. It's one of the most repeated pieces of financial advice in America, and almost nobody who says it has actually run the numbers behind it. Today, we're running them line by line, and the answer is not what you've been told. Meet Marcus. He's 32. He spent the last few years saving, and he's got $43,000 sitting in a savings account. Everyone in his life is telling him the same thing. Stop renting, buy a house, stop throwing money away. He's staring down two doors, and everyone around him insists only one of them is the smart choice. Let's actually open both. Before we get to Marcus, it's worth asking where this idea even came from. Renting is throwing money away isn't some ancient piece of wisdom. It took off as common advice in an era when interest rates were low, home prices grew steadily for decades, and owning genuinely was the cheaper option almost everywhere in the country. The advice stuck around. The housing market underneath it changed completely. Nobody sent out a memo updating the catchphrase. Start with the door everyone's pushing him toward. The median home in the United States right now costs about $430,000. Marcus takes his $43,000 and puts it down as a 10% down payment, then finances the rest with a mortgage. At today's average interest rate on a 30-year fixed mortgage, about 6.5%, his monthly loan payment, just the principal and interest, comes out to roughly $2,450 a month. For most people, this is the biggest financial decision they'll make in their entire life, bigger than any car, bigger than most people's retirement contributions in a given year. And yet the way most people evaluate it comes down to one number they saw on a mortgage calculator compared against one number on their current lease. That's it. That's the whole analysis for a decision worth hundreds of thousands of dollars. And for most people, that's exactly where the comparison stops. $2,450 a month building equity in an asset he owns versus paying rent that vanishes into a landlord's pocket forever. On the surface, buying looks like the obvious, easy win. Stamp it. Case closed. Except that $2,450 number isn't actually what it costs Marcus to own that house every month. It's not even close, and this is exactly the gap that never makes it into the Thanksgiving dinner version of this argument. Here's what the mortgage payment conveniently leaves out. Principal and interest is just the tip of the iceberg. Everything below the waterline is where owning a home actually starts costing real money. First, property tax. It doesn't show up on a mortgage calculator ad, but every homeowner pays it every single year for as long as they own the home. On a $430,000 house, the national average property tax rate works out to roughly $394 a month. Second, homeowners insurance. Nobody budgets for this until they own a house and the bill shows up. Call it around $160 a month on a home this size. And in a lot of states, especially ones dealing with more frequent wildfires, floods, or hurricanes, that number has been climbing hard the last few years, not falling. Some homeowners in high-risk states have watched their premiums double in a single renewal cycle. Third, because Marcus only put down 10%, not the full 20% lenders like to see, the bank requires him to carry private mortgage insurance. And here's the part that stings. That insurance doesn't protect Marcus at all. It protects the lender in case he defaults. He's paying roughly $193 a month for a policy that exists purely to cover the bank's risk, not his. And fourth, maintenance. Roofs wear out. Water heaters fail. Furnaces die in the middle of winter, always at the worst possible time. A common budgeting rule among financial planners is to set aside about 1% of a home's value every year for upkeep. On this house, that's roughly $358 a month, whether Marcus spends it that particular month or not. Some years it's nothing, some years it's a $5,000 HVAC replacement all at once. The monthly average just smooths that lump out. One more thing worth mentioning, because renters aren't cost free either. Renters insurance exists too, but it typically runs somewhere around $15 to $20 a month, covering just your belongings rather than an entire structure. It's real, but it's small enough that it doesn't change the shape of this comparison. Now stack every one of those homeownership costs on top of the mortgage payment. Add it all up, and Marcus's real total monthly cost of owning this house isn't $2,450. It's about $3,550. Let that sink in for a second. Over $1,000 a month every month that never showed up in the renting is throwing money away version of the story. Now put that $3,550 next to what it would actually cost Marcus to rent an equivalent home right now. Nationally, the average rent across all property types today runs about $2,000 a month. Do the subtraction and you get a gap of roughly $1,550 every single month. Owning this particular home costs Marcus $1,550 more per month than renting the same kind of home. And that gap exists before he's built a single dollar of equity he could actually spend, sell, or borrow against. So here's the question nobody asks at the dinner table. What if Marcus takes the other door? What if he rents instead and takes that $1,550 a month gap, plus the $43,000 he never handed over as a down payment in the first place, and invests all of it? At the stock market's long-run historical average return, somewhere around 7% a year after inflation, that money compounds. And compounding is deceptive. For the first few years, the growth looks almost boring, barely worth mentioning. After 10 years, renter Marcus has about $340,000 invested. Respectable, but not exactly headline grabbing. This is the boring part of the curve. After 20 years, it's roughly $930,000. Now it's getting interesting because the last decade added more than the first two combined, purely from compounding on top of itself. Run that scenario out a full 30 years, the same length as Marcus's mortgage, and renter Marcus is sitting on somewhere around $2 million? $2 million? Liquid? Diversified across an index fund, not tied up in a single piece of real estate in a single zip code. He can retire on it, relocate with it, hand it down to his kids, or do nothing with it at all except watch it keep growing. Owner Marcus, meanwhile, finishes those same 30 years having paid off his mortgage completely, sitting in a house that's appreciated over time to roughly $1.1 million. After accounting for the roughly 6 to 8% he'd lose in fees if he ever actually sold it. Both of those numbers represent real wealth. Nobody's pretending owner Marcus made a bad decision. But they are not the same kind of wealth, and that difference matters more than people admit. Owner Marcus can't spend a bedroom. He can't pay for a car repair with a hallway. To actually access his $1.1 million, he has to sell the house, pack up 30 years of his life, and go find somewhere else to live, and pay real money to do all of that. So ask yourself honestly, which version of Marcus was the one throwing his money away? Part of why this myth survives is something economists call money illusion. A house feels real in a way a number on a brokerage app never does. You can stand in it, paint the walls, host Thanksgiving in it. A brokerage balance is just pixels on a screen, even when it's worth twice as much. That feeling isn't irrational exactly. A shelter is a genuine need a portfolio doesn't satisfy. But it's also not the same thing as the number actually being bigger. Marcus's uncle isn't lying to him. He's just measuring the wrong thing and calling it math. Now, the honest catch, because this channel doesn't do one-sided math, that $2 million number only exists in a world where renter Marcus actually invests that $1,550 every single month for 30 straight years, without fail. Instead of upgrading his apartment when he gets a raise, or buying a nicer car, or just spending it the way most people spend money that isn't automatically deducted from their paycheck. For a huge number of people, the forced structure of a mortgage payment is the only reason they ever save anything meaningful at all. That's a completely legitimate argument for buying a home. Discipline has real value even when a spreadsheet can't put a number on it. There's also a tax angle people bring up here, so let's deal with it directly. Mortgage interest can be deductible if you itemize. In practice, most homeowners today take the standard deduction instead because it's larger for most incomes, which means the tax benefit of owning is smaller in real life than it is in the theoretical version of this argument that gets repeated online. And this math isn't universal across the country either. It depends heavily on where you actually live. Take a home's price and divide it by its annual rent, and you get something economists call the price-to-rent ratio. Below 15, buying usually wins outright. It's not even close. Above 20, renting usually wins by a wide margin. And a lot of the country's most expensive coastal cities, the exact cities where everyone insists you obviously have to buy eventually, are sitting well above the 20 mark, sometimes way above it. So the real lesson here isn't renting is always smarter, and it isn't buying is always smarter either. It's that the $1,550 a month gap is real money sitting right in front of you, and whether it makes more sense to put it into a house or into an index fund depends on the actual math in your specific zip code. Not on a slogan your uncle repeats every Thanksgiving. Marcus isn't wrong for buying that house. He wouldn't be wrong for renting and investing the difference instead either. The only genuinely wrong move here is picking a door because of a catchphrase without ever once running the numbers behind it. If you want to actually check this for yourself, it takes about 10 minutes. Look up the median home price in your area. Look up the average rent for something comparable. Divide one by the other. That single number tells you which side of this argument your city actually falls on. Not the national average, not what worked for your parents in a completely different housing market decades ago, and definitely not what your uncle said at dinner. If this is the first time anyone's actually shown you the real math behind renting is throwing your money away, subscribe. Every video on this channel takes one thing that everybody just assumes is true and actually does the math on it instead.